Imagine finding your dream home, a perfect 3-bedroom with a fenced yard for $380,000, only to discover you can't even make an offer because you haven't been pre-approved. It's a crushing feeling and a common mistake for first-time homebuyers. In today's competitive U.S. real estate market, a pre-approval isn't a nice-to-have. It's a non-negotiable requirement. Sellers won't even look at your offer without it, and realtors often won't take you seriously. This document proves you're a serious, qualified buyer, giving you the upper hand when multiple offers hit the table. But what exactly is it, and how do you get one? Stick around, because understanding this process can save you weeks of heartache and potentially thousands of dollars, starting with the critical difference between pre-qualification and pre-approval. Many people confuse mortgage pre-qualification with pre-approval, but they are vastly different. Pre-qualification is a quick, informal estimate based on your self-reported financial information. You might call a lender, tell them your income, debts, and assets, and they'll give you a ballpark figure, say $350,000. It's like a quick chat with no real commitment. Pre-approval, however, is a rigorous process where a lender thoroughly vets your financial health. They actually verify your income, employment, credit history, and assets. This deep dive means a pre-approval is a conditional commitment from the lender to loan you a specific amount, usually valid for 30 to 90 days. It's the real deal, backed by verified documentation, but there's a critical step before you even approach a lender. Before you even think about contacting a lender, you absolutely must check your credit score and report. Your FICO score is a major determinant of your mortgage interest rate and eligibility. Lenders typically look for a minimum score of 620 for conventional loans, though FHA loans can go as low as 580 with a higher down payment. A score below 670 might mean a higher interest rate, costing you tens of thousands over the life of the loan. For example, on a $350,000 mortgage, moving from a 720 to a 640 score could easily add half a percentage point to your interest rate, translating to an extra $100 per month, or $36,000 over 30 years. Order reports from all 3 bureaus, Experian, Equifax, and TransUnion, and dispute any errors immediately. This proactive step is crucial because what lenders examine next goes far beyond just your score. Lenders need to see a stable and reliable income history to approve your mortgage. They typically require 2 years of consistent employment in the same field or with the same employer. Be prepared to provide pay stubs from the last 30 days and W-2 forms for the past 2 years. If you're self-employed, it's even more critical. You'll need 2 years of tax returns and a profit and loss statement. Lenders want to confirm you have the capacity to repay the loan, and any significant gaps in employment or recent job changes can raise red flags. Let's say you just started a new job last month, even with a higher salary. That lack of history could delay your pre-approval by months. But your income isn't the only number they're scrutinizing. Your existing debts are equally important. Your debt-to-income, or DTI, ratio is one of the most critical factors lenders assess. It measures how much of your gross monthly income goes towards debt payments. There are 2 parts: your front-end DTI, which is your housing expenses, mortgage principal, interest, taxes, insurance, divided by your gross income, and your back-end DTI, which includes all your monthly debt payments, car loans, student loans, credit cards, plus housing expenses, divided by your gross income. Most lenders prefer a back-end DTI of 36% or lower, though some programs go up to 43 to 50%. For instance, if your gross monthly income is $7,000 and your total monthly debt payments are $2,000, your DTI is 28.5%. But if those debts jump to $3,000, your DTI hits 42.8%, making approval much harder. This ratio directly impacts how much you can borrow, and it's a number you must optimize before applying. Lenders need to verify you have sufficient assets for your down payment and closing costs. This means providing bank statements, usually for the past 2 months, for all checking, savings, and investment accounts. They're looking for stability and the source of your funds. Large, sudden deposits right before applying can be a red flag, prompting lenders to ask for a source of funds letter. For example, if you're putting down 5% on a $380,000 home, that's $19,000. Closing costs can add another 2 to 5%, or $7,600 to $19,000. So, You might need $26,600 to $38,000 readily available. If a family member gifts you funds, you'll need a gift letter stating it's not a loan. Having these funds clearly documented is crucial, but what about the actual application process itself? Once you've gathered all your documents, pay stubs, W-2s, tax returns, bank statements, and credit reports, you're ready to apply. You can apply with multiple lenders within a short window, typically 14 to 45 days, without multiple hits to your credit score, as they'll be treated as a single inquiry for rate shopping. Start with your current bank or credit union, but also explore online lenders and mortgage brokers. A mortgage broker can be particularly helpful as they shop your application to various lenders to find the best rates and terms for your specific situation. They act as an intermediary, saving you time and effort. Once submitted, the lender will pull your credit, review your documents, and typically within a few days, issue your pre-approval letter. But don't make this common mistake after getting it. Here's a pervasive myth. Once you have a pre-approval, your financial life is set until closing. Absolutely not. Your pre-approval is based on your financial snapshot at that moment. Making significant changes can jeopardize it. Don't open new credit cards, take out new loans, or make large purchases like a new car or furniture on credit. Doing so will increase your DTI ratio and can directly impact your loan qualification. For instance, if you get pre-approved for $400,000, then buy a $30,000 car with a $500 monthly payment, your DTI might jump enough to reduce your approved loan amount by $50,000 or even revoke it entirely. Also, don't change jobs unless it's within the same industry and provides a clear, documented increase in pay. Your financial discipline needs to be ironclad until closing day. But what happens if your pre-approval expires? Mortgage pre-approval letters typically have an expiration date, usually 60 to 90 days. This is because your financial situation, credit scores, and market interest rates can change. If your pre-approval expires before you find a home or close on one, don't panic. You'll simply need to update your financial documentation with your lender for a reapproval. This often means providing recent pay stubs and bank statements. While it's generally a quicker process than the initial application since the lender already has most of your information, it's still a good reminder to be efficient in your home search. If your financial situation has changed significantly, like a job loss or new major debt, a reapproval might not be guaranteed at the same terms. This brings us to a crucial strategy for using your pre-approval effectively. Your pre-approval letter is more than just a piece of paper. It's a powerful negotiation tool. When you make an offer on a home, attaching your pre-approval letter signals to the seller that you are a serious, qualified buyer. In a multiple offer situation, a strong pre-approval can make your offer stand out, even if it's not the highest bid. Sellers want certainty that the deal will close. A pre-approval from a reputable lender provides that confidence. Consider this. A seller receives two offers, one for $385,000 with a solid pre-approval, and another for $390,000 from a buyer who is only pre-qualified. Many sellers will choose the slightly lower, more secure offer. This strategic advantage is invaluable, but there's a major mistake many buyers make regarding the approved amount. A huge mistake many buyers make is buying a home at the absolute maximum amount they are pre-approved for. Just because a lender says you qualify for $450,000 doesn't mean you should spend that much. Lenders calculate based on strict financial ratios, not your lifestyle or comfort level. They don't factor in your monthly budget for dining out, hobbies, childcare, or unexpected emergencies. Let's say you're approved for $450,000 and your monthly payment, pity, is $2,800. If your comfortable budget was actually $2,400, that extra $400 per month adds up to $4,800 a year, a significant strain on your finances. Always determine your own comfortable monthly housing budget and stick to it, regardless of the maximum pre-approval amount. Otherwise, you risk becoming house poor, and that's a situation to actively avoid. So, what are your immediate next steps? First, get your credit reports and scores. Review them thoroughly and dispute any errors. Second, start gathering all your financial documents. 2 months of bank statements, 2 recent pay stubs, and 2 years of W-2s or tax returns. Third, Research and contact at least 2 to 3 lenders or a mortgage broker to compare rates and terms. Remember, applying with multiple lenders within a short period counts as a single hard inquiry for FICO scoring purposes. Don't be afraid to ask questions and negotiate. Doing this legwork upfront not only streamlines your home search but also puts you in the strongest possible position to secure your dream home. The single biggest takeaway is this: mortgage pre-approval is your essential first step in buying a home, providing financial clarity and a powerful negotiation tool. It's not just about getting a number. It's about verifying your financial strength to both yourself and sellers. By understanding this process, preparing diligently, and avoiding common pitfalls, you position yourself for a smoother, more successful home buying journey. If you found this information helpful, please consider subscribing for more insights into navigating the complex world of U.S. real estate.